Whoa.
Thank you so much for being with us here today. We've got a really incredible panel ahead of us, and I hope you get a lot out of it. Just to start us off, as an intro, when the Chicago Mercantile Exchange launched Bitcoin futures back in December 2017, it was a real TradFi meets crypto milestone. And now here we are almost 5 years later, and after a pretty interesting 2022, and derivatives remain a staple of digital asset markets, and in myriad forms, from Dogecoin futures on Kraken to Zcash perpetual futures on Binance, option contracts on Deribit, all sorts of decentralized options emerging, and of course, Bitcoin and Ethereum futures on the CME. So in recent weeks, people are still using derivatives. CoinDesk colleagues reported that after Shanghai upgrade on the Ethereum blockchain, a lot of institutional investors were using derivatives on CME to bet on Ether price. So during this session, we will talk about where some of our key players see all of this going. This conversation will include various types of venues for trading futures and options and perpetual swaps, both CeFi and DeFi. One thing we will not be talking about is liquid staking derivatives, which do use that term derivatives, but are something sort of entirely different. Thank you, panelists. I think y'all have already been introduced, so we'll just dig right into it. Nicola, just to start off, give us kind of an overview. You're our customer here of the panelists. Well, from your perspective, what are the major venues for trading crypto derivatives in April of 2023?
Yeah, so I think we've come a long way in a year. If I think back to last year, options was kind of a topic that not a lot of people were talking about. We've definitely seen those markets develop a lot over the last year. But I would almost say that they're split into two at this point. So there's definitely the unregulated venues versus the regulated venues. So when you were giving the introduction, CME, CBOE all fall into that regulated space. So in the US, typically at this point, traditional finance players that are taking liquidity or making liquidity onto those venues. And then if you kind of flip to the unregulated side, you have like the venues like Deribit, Paradigm. That's where most of the business is going on, and all the major exchanges as well who are listing perpetual futures, right? So I think those sit typically offshore. And there's not, they're either operating in, a Panamanian jurisdiction or Malta or, some unknown jurisdiction, depending on what kind of venue you're facing.
And just to give us a little orientation, what would you say is the venue that B2C2, of those, where do you spend most of your time?
So again, depends. I'll caveat it with saying it depends on where we're trading. So our US, so we provide liquidity to customers, and when we're facing customers in the US, we're typically trading on the either bilateral, so we'll face the client directly, or we're trading on the regulated exchanges, right? And we're very careful with what we do in the US. We know regulation is probably the most talked about topic at Consensus this year. And so we want to be very, very careful with what we're doing inside the US. Outside of the US, we have a Cayman Islands entity where we trade, I would say we trade a lot on Deribit, on some of the exchanges like Binance, that type of thing. And yeah, that's typically where we'll source liquidity to face our clients. But keep in mind that we're always putting our capital at work, so it's not like we're matching buyers and sellers in the derivative space. We're actually creating liquidity in the derivative space to help our clients either hedge their portfolio or take an outright position.
Thank you. Dan, this next one's for you. I mean, the concept of CFTC regulated, okay? In crypto, obviously a pretty broad spectrum of crypto players, but how does that branding of CFTC regulated? Is it like, if you're leading with we're CFTC regulated, how does that play at this time versus, say, maybe a year ago?
I mean, I think it's probably more of a main topic today, especially post FTX. And I think that, it is, again, CFTC is such a force, and obviously it's US based. And I think when you have derivative exchanges or matching engines, clearing venues, that are US focused, this is where the CFTC conversation comes in. Once you step outside of the US, it obviously has different meaning. If you're in the UK, it's going to be the FCA, or I think globally now there's several jurisdictions that are focusing on different levels of virtual asset licensing, derivatives licensing. So I think now it's obviously, again, post FTX become more of a main topic. Tend to focus everything outside of the US. So I think, for me, the focus is really on what's developing in a regulatory landscape, non-US.
Interesting. Robert, let's go to you. The TMX, you are proposing to get into Bitcoin futures and options among, other sort of crypto adjacent or crypto products that you have. And that's in Canada. And I think that would be interesting if you could just walk us through what is your journey to get approval. I think your CEO mentioned early last year that you were going to be able to have that launched in 2022. Here we are, 2023. What is that journey like for you to get approval to launch?
Sure, and I think it's an important one because for us as sort of the lead marketplace in Canada offering equities and derivatives, we're held to very high standards from a regulatory standpoint. So when we look at inching into a new asset class, working with regulators is key. And I think that's been a theme throughout Consensus. And where I applaud the Canadian regulators is they clearly want to know what our strategy is. We have regular touch points with them. And not only are they regulating the trading platform, but also the central clearing platform. And at TMX, we're deemed systemically important to the Canadian financial system. So going through those regulatory processes and education, we have to start small. We have to start with cash settled, sort of Bitcoin futures, and then we could inch into new product offerings. And we're, like you said, we're currently in the crypto space through the ETFs and ETF options. So we have a robust framework already in place that we're comfortable with. Now it's just expanding on that asset class.
And maybe just talk a little bit about where does that get you in terms of your business? Like you do all that work to get the approval, like revenue, like how is it going to move the needle for TMX?
So basically a little bit what Nicola was saying, we believe the derivatives market and a healthy derivatives market is important to just market structure. So once you develop that liquidity, it feeds into the overall system. Our play here, and a lot that we've discussed over the course of the day, is when institutional investors come to market. And one thing that when we deal with our customers, some of them don't want to be in the underlying asset, but they want to have exposure. And one element that there's many great products out there in the derivatives world, but there's tracking errors. And there's a certain amount of clients that want to be able to track their risk. And if they're hedging against something that is not necessarily tracking what they're benchmarked against, well, that's sort of an inherent risk, and they come to us to see if there's a way that we could fill that gap. And that's really what we're trying to do.
Nicola, this next one's for you. Derivative, you mentioned all the various venues, and you have your offshore affiliate that can only access certain of those pools. And with the regulatory climate that we have currently, do you think a lot of that stuff is getting pushed offshore, a lot of the volume?
Yeah, we've definitely seen people move to Bahamas, Bermuda, like firms actually pick up from the U.S. and move offshore. I think one would argue after the events of last year, you could make the parallel that introduces risk into the system. And part of the reason why you want a regulated platform, I mean, even go back to traditional finance. In '07 and '08, right, the whole Dodd-Frank was to make swaps, safer and secure, make sure that you're not extending too much leverage, make sure that the customers are protected. And we would really benefit from having kind of those rails and clarity on those rails, right? Because I think even now you're seeing in the US, there's some uncertainty about, kind of who owns what. And I think, so that's really what people are looking for. And I think that would be what stops, business moving offshore and people actually physically moving out of the US.
And what about, people talk about the long arm of the law, of the US law, and if there's a long arm of the SEC, is there a long arm of the CFTC?
I mean, the one thing I would say with the CFTC is I think that they are, from the conversations we've had, they've been relatively open, listening. They definitely want to learn more about the space. And let's be clear, it's a really complicated space. And so that's another reason why I think it makes sense to make sure that we're educating clients, regulators, and we're spending the time to talk about the nuances of regulation, because it's not just taking a playbook from traditional finance and applying it into the crypto space. We really need fit for purpose regulation, because otherwise what that means is all of the innovative, advances you get with crypto, you lose if you're trying to pigeonhole them into, existing regulation.
If I could add
go
to
ahead,
that,
Robert.
if you don't mind, just like in terms of the Canadian regulatory landscape, we applaud the Canadian regulators. They had a path forward for a lot of the crypto trading platforms offering their services in Canada. And since a lot of the insolvency events that occurred, they recently published a staff notice, I think at the end of February, sort of having that line in the sand. And anybody who's unregistered in the Canadian market, they essentially required them to be registered in the sense that it has to be an even playing field. And they gave them 30 days sort of to comply with those requirements. Some of them were around custody, and that's something that is really important. And it's important as well in the derivatives market from a centrally cleared perspective. But custody and segregation of accounts, and that's what we do. When they look at pledging and rehypothecation, that is something that they were precluded to do. And of course, margin and leverage. And that was explicit in their staff notice. So anybody who's unregistered in the Canadian market, not allowed to offer sort of that leverage. And that path forward, I think, is really helpful for those CTPs that want to offer spot, but also derivatives in the Canadian marketplace. They have a clear path to registration.
Just changing gears a little bit.
Sure.
Dan, you're an expert here on decentralized options for derivatives trading. Or derivatives, options, solutions. Maybe can you just give us a little bit of the landscape from your perspective? What are the big solutions out there, the big options, do they see themselves as competitors to kind of these centralized derivatives exchanges?
Yeah, I think there's a couple of tentacles there. One is just the landscape as a whole. One thing in the unregulated portion, as Nicola's kind of alluding to, things that are offshore in jurisdictions that don't have any regulatory regimes around them. There's a lot of exploration in new product sets. I think a year ago, a guy named Dave White from, I think Paradigm came out with this everlasting options concept, something that started to pick up in some smaller circles and some offshoots of that. And there's a lot of derivatives of derivatives that are being explored. And one of the nice things about DeFi is the ability to kind of have this, you have this community of people on a globally dispersed basis that are willing to kind of experiment and test. They're almost like test pilots in a way. And there's a lot of crashing and burning that goes on, but out of it comes innovation. And I think one of the, kind of to loop it back to what the previous question was, one of the issues that you have is you don't have this kind of like sandbox or safe place that exists. A lot of the things that you build in the space right now, if you're trying to be very, kind of at the edge of the tip of the spear, is things are simply unregulatable. They're not covered by any form of regulation. So there's really nothing you can do with it other than to be in a sandbox in some small jurisdiction. I think that's one of the things that need to be explored to allow innovation to really unlock and happen.
And so what comes next then?
Who knows? Every day seems like a new adventure in this space, and I think so much depends on the current regulatory regime. I mean, obviously, again, back to the CFTC, it does have very strong reach, and I think there's a lot of things going on between the CFTC and SEC just around crypto in general, and who knows how that's going to play out. And I think we're trying not to speculate one way or the other on, and just kind of take things as they come and figure out how to work within it.
Well, okay, so maybe just the basic concept of derivatives, where there's obviously lots of leverage, right? And it's who is the primary customer for crypto derivatives? Is it an institution that wants to, bet on crypto in a non-crypto native way, or without holding the crypto, or is it, some degen who wants to go long without a ton of capital down? Like, where's the biggest market here?
I actually think we've seen the market kind of, I would say get spread out over the past year, right? You've seen a lot more players come in. So traditional finance are using crypto derivatives as a way to get access to the space, right? So I worked at a large bank for a very number of years. They're bogged down in legacy technology. It's really hard for them to think about the concept of, how do I create blockchain technology? How do I think about safety, MPC, all of those things that we're so used to in the crypto native side of things? That's really, really hard for them. But what isn't hard for them is cash settled derivatives, because they do it today. It's products that they're familiar with, like NDF, CFDs, or products that exist in traditional finance. And so it's a really good way to get traditional finance money into the space. On the flip side, I would say on the crypto native side, you definitely want crypto native firms hedging their portfolios more, so there's not as much pain when the market sells off. And so I think you're seeing this nice mix. And look, you're always going to have speculators. People would trade a widget. There's some people that would trade anything that was out there. So you're always going to have those speculators in there as well.
And if I could add to that, in terms of just the use of derivatives, and what we've seen, a lot of it is on the back of ETFs that were launched in Canada that are based on an underlying index, and the ETF structure itself holds the digital asset. So the tracking of Bitcoin and Ether is currently what's available. It's really a pure play. So a lot of traditional sort of investors will dip their toes into that market. And where we offer the options market, and what we've seen a big shift from crypto winter into the start of 2023, our volumes are up over 200%, and so is open interest. But that's really from two segments of the market. One, reduced volatility, so yield enhancement. So there's a lot of systematic overriding strategies, and then typical call buying and call spreads to the upside, because everybody wants to see Bitcoin and Ether go up. And the difference between calls and puts is like 80% to 20%. So as we continue to see the investor demand, clearly there has to be an uptake in the crypto asset market, but there's a demand to get in that market, and we're seeing it. And even though we don't always know who the end customer is, the data is telling us that they want that synthetic exposure, and they want to do it through either leverage or be able to do it through reverse conversion type transactions in the options market.
Just going back to kind of the events of 2022, which emphasized counterparty risk management, right? And that is at the core of what the clearinghouse and settlement process is all about. How does DeFi handle this? Is it just
I think this is back to the innovation point. One thing that's coming out of DeFi, you're kind of seeing this, and I think some people have coined it maybe Web 2.5, where you have and you mentioned about MPC, you're seeing a lot of exchanges now pop up that are kind of this hybrid that exists between a centralized exchange but like settles to a blockchain, settles to a DEX. And so where like maybe some of the deposits and withdrawals are, are protected by like some form of consensus at the blockchain layer, or transactions are validated at the blockchain layer. I know there's a couple big projects that are building on something called Firedancer. That's a new validator client that's launching on Solana, which is a blockchain that Hxro is built on. But I'm starting to see it across the way. So you're starting to capture some of the advantages of like the self-custody that come from DeFi, but with kind of more of a centralized experience. And maybe those are the types of things where, along with the KYC and FATF stuff that needs to be overcome, these exchanges are still doing full KYC. You get this kind of nice mix of some of the technology that's been innovated out of crypto, out of DeFi in general, and with some of the things that more traditional participants are used to.
Just to stay with, just to look at DeFi derivatives, what would be the sticking point, or what is that? What do they need to overcome to start to be mentioned in the same conversation?
I think some of the biggest issues are, more than anything, are really around KYC, FATF, things like that. And like an institution is going to have a very difficult time transacting into a fully anonymous blockchain, or into a fully anonymous network where they don't really know, or there's no confirmation of the participants at the app layer or at the entry layer. And I think a lot of that is starting to evolve now. Anything from soul-bound tokens, soul-bound wallets. There's a lot of elements that are starting to be introduced now to solve for KYC within a DeFi context. One being this kind of like SEX DEX hybrid is kind of one solution. And how we move to a more pure DeFi solution and really go along, to keep pushing on this path of a more disintermediated, dispersed, ways of dispersing systemic risks and things like that, I think are coming in the future. But I think this is a nice kind of next step.
The concept, there's a lot of spot crypto exchanges that offer derivatives, right? And maybe one question, maybe this one's for you, Robert. What's the potential that, CME, obviously it's a derivatives exchange, but would they ever get into spot crypto, or would that be part of the TMX plan?
I guess you never say never. I think it's something that we're looking very closely at. In terms of the investor demand that we're seeing, there's a demand both on the spot side of the market as well as the derivative side. So I think working with the regulators, working within that framework, if TMX sees that there's a role and sort of a problem that they could solve in the market that would meet the investor demand, and of course our constituents of clients, which are going to be the broker dealers in the Canadian market, then absolutely we want to play a role and we want to be the go-to marketplace to service them. Yeah.
And I was just talking with somebody from Crypto.com. They made an acquisition in 2022 of a company called Nadex, and they started doing options trading. How is that? Are they a competitor?
I don't have a comment on that. No.
What do you think, Nicola? Is there an explosion in this space of offerings, or do you think it's going to be more concentrated?
Look, I hope that there is, right? And I think the one thing that's kind of stopping that explosion from happening is regulatory clarity. And I also think the other thing that we need to get in the space is a regulated spot market. Because if you look at when the CFTC denied the physically settled ETF, in their footnote, like buried deep, they said they would approve it if and when there was this regulated spot market that can conform to essentially the equity rules in the US, right? And so if you think about the evolution, cash settled derivatives, regulated spot market, and then you can get physically settled derivatives. And I think that evolution, once you get to the physically settled derivatives market, you're kind of operating at full scale. You've got TradFi in there. They're kind of pumping money in, and I think that's really what the evolution is going to be that we'll see over the next couple of years.
But I really think that evolution is occurring. Like the conversations are happening. I think regulators are not being opposed to it, at least we're not seeing it. So it's just a matter of figuring out what's the right time, what's the right framework. And events that happen right now, I think, spooked a lot of the market. But long term, it's probably going to help it because safeguards are going to be in place. And to your point before, in terms of the competitive nature, I think we're always a believer that the more derivatives activity that occurs, the better. We want as many investors to be knowledgeable of the use of options and futures.
But if I can, I think it's important to separate, what happened with some of the FTX events from crypto, right? Because FTX was an alleged fraud event. It didn't have anything necessarily to do with crypto. And I think it's really important we separate the two and that it doesn't set us back, right? Because there is a lot of interest in the space. It's probably one of the more innovative uses of technology we've seen in finance in decades, right? And so I think that's why it's really important to make sure we're separating the two.
Nicola, we've got 2 minutes left, and it's the last one for you here. You and I had an interesting conversation about something that sounds super ridiculous, but it's Dogecoin futures, okay? And my colleague Shorty Malwa, he wrote a story about how there was a huge explosion in open interest in Dogecoin futures based on some aggregator, but you mentioned in our pre-interview that you are an institutional investor trading Dogecoin. When you hear that term Dogecoin futures, is it like something very familiar that you use? And
so it's not something that we use or something that we trade, although let's be completely clear, there's a lot of volume that goes through in Dogecoin when a certain individual tweets. And with that, then if you want to make a bet on what's going to happen, is it going to become the official coin of Twitter? I'm not making any predictions here by any stretch, but there's clearly a power in Elon Musk's tweets, and so it's not surprising that someone's created a future that tries to predict where the price of Dogecoin is going to go.
I mean, maybe another way of putting it is the whole concept of Dogecoin futures, does that sort of make a mockery of CME Bitcoin futures, for example? Like, in other words, the most serious regulated part of crypto derivatives to something like that.
I mean, look, I would say all products are not created equal, right? So when someone's getting into trading a product, they need to understand the intricacies of the product that they're trading, and there's going to be inherently more risk in trading a Dogecoin future on X, Y, and Z exchange than there is going to be trading Bitcoin and Ethereum futures on a U.S. regulated exchange. And you need to kind of do your due diligence and make sure that you understand the intricacies of the product you're trading and the platform that you're trading on.
Great. Well, I think we're out of time. Thank you to our panelists. Thank you to our audience. We really appreciate you joining us today.
Thank you.